Welcome everyone to the second session of Cambridge Connect's peer-to-peer conversation. Today we're going to have quite an interesting subject on pricing, venture capital math, and so forth. Thanks to the participation of Rodrigo Castro. He's a seasoned entrepreneur and venture capitalist here from Chile, investing in LATAM. Please, some of the notes that I wanted to share at the beginning as last session. Remember, this is a conversation, so everyone is invited to capture your questions in the chat box. So Steve Lyle is going to help us out reading them out loud at the end of the session. So you can start capturing all the notes, all the lessons learned, all the information that is of value to you. Remember, the microphones should be off in order to engage in this participation at the end. And all the Q&As are questions. All the questions are more than welcome, sorry. I'm going to be your host today. I'm the Cambridge Business Association Director here in Latin America. We are creating a commercial bridge between LATAM and the UK. I'm also partnered in Oxbridge Capital Partner, which is the newly created venture capital firm based here in Chile and in the UK. The agenda, as I previously told you, is going to be quite interesting. These are the 4 topics that we are going to be covering today. We hope that these are of value to you. We have captured some questions received previously in order to answer all the questions that were in the parking lot from last session. And the new ones that we are not able to cover, we are going to do the same in session number 3 next Friday. Remember, this is a series of webinars that are happening every Friday at 3 o'clock UK time. Before we get started, I would like to acknowledge all the strategic partners we got for Cambridge Business Association, eClass, which is the professional platform for executives in LATAM for all the type of courses you can imagine. Renaissance Executive Forum, which is a secure place for CEOs and founders to learn, grow, and share their own knowledge, doubts, fears, whatever, in a secure place. Hacienda Santa Martina, which is a nature club for all the members of Cambridge Business Association who want to go there with their families to relax and enjoy. They are more than welcome to request more information. And of course, Oxbridge Angels, who are based in the UK. We're 82 investors from the Judge Business School. We have the privilege today of having Jasreen participating also in the webinar. This is the stellar faculty we got today. Today, the professor is going to be Rodrigo, as I said at the beginning. I'm pretty sure that you remember the rest of the panelists. I won't ask you guys to introduce yourself again, but this is the faculty we got. We are all going to be participating in some way or another during this webinar series. So in order to dive in directly into what brought us here today, I'm going to leave you with Rodrigo Castro, the managing partner of Genesis Ventures, based here in Santiago, Chile. Welcome, Rodrigo.
Thanks a lot, Guillermo. I'm very pleased to be here in this second session. I would like to thank as well Cambridge Business Association, the Latin American office, as well as the University of Cambridge Judge Business School to put together this series of webinar. Today, my idea is to cover one of the most important core of the venture capital industry and the venture capital firms is the whole process from the screening up to the harvesting or exit of the portfolio companies we used to invest as an asset class, alternative asset class. So my idea is to go through it, even though I'm going to try to cover in depth a lot of issues. Some of them is going to be, I would say, the highlights. So I think it's important to start from the very beginning, this story, in terms to place the venture capital as an alternative asset class within the private equity landscape, in where we have the leverage buyouts funds, the VC funds as well, the mezzanine capital distress debt, as a quasi-equity asset class, everything is within the private equity landscape, and venture capital is one of them. If we look to the right-hand side chart, we have our investment focus and where we capture the venture capital within the deal size, as well as the risk we need to manage and face. We used to be on the high risk asset class, like the hedge funds, but in average, we deal with small size ventures. Even though we, in Chile, as well as in Latin America, we have a whole set of venture capital firms focusing on early stage as well as seed stage. The developed markets used to move ahead in terms of the deal size, even though if we compare with the private equity and the hedge funds, we are small ones. Going back to the history of the VC industry, we need to go to the mid 40s in the US, in which we have some beginning, but the VC industry starts really around the 60s in the US, in the both coast, east and west. But it's not until the 80s that gets an estimated size of around $1 billion, around 750 and $1 billion. And our focus is in this alternative asset class is to have a unique structure and focus. We normally organize as a limited partnership and private investment funds. That would be our case in the Chilean market and in other landscape in Latin America. But in the US as well as in Europe, they used to structure the VC firms as a LP limited partnerships. We have a sort of the same structure as a private investment funds in terms of the way we manage the risk for the LPs, the investors. They used to commit for these funds, and our main task would be to invest in high risk ventures with potential for high growth return. That would be our main core business. Is not to invest in real estate or capital markets, is to invest in real companies, early stage or seed companies that has a very interesting and growth potential in their business models, and for sure they have high risk. So we need to manage the risk with the potential returns or the expected returns for our investors. So if we look on the bottom, we have the business development process in terms of a company from a napkin up to the stage of scalability. And we used to focus on the startup stage as well as the development stage. So here you have the venture capital firms or funds that used to move around between the startup and development stage. We used to structure VC funds for a 10-year period. We have the opportunity to extend that 10-year period to 12, but we used to invest within the first 5 years and harvest our portfolio companies on the second term, of 5 years in average. But we used to connect with the whole business development process with universities, incubators, as well as accelerators and business angels as well. I brought this story because it's quite important, the role of George Thorogood in the birth of venture capital in the US. He was a French coming to the States, and he founded American Research and Development Corporation in Massachusetts in the late 40s. And it's quite important because he lead in some way the structure of what a VC firm has to focus. And since then, the factors that have been enhanced or fosters the VC growth are mostly the institutional investors. When institutional investors got in this alternative asset class, we saw an explosion, a boost of new BC funds, larger BC funds as well, and all the entrepreneurial ecosystem boost as well. So that would be a challenge for the Latin American landscape to get involved, the pension funds, insurance companies, as well as to structure endowments or bring the endowments from multi or single family office to this asset class, to diversify for sure. It's one of the different assets that single or multi-family offices or institutional investors could invest. So we need to address that. Many countries in Latin America has been restricting, even though Mexico as well as other countries, Mexico is one of the leading ones, bringing the institutional investors to the BC industry. But hopefully here in Chile, we are going to have we have already different regulatory frameworks that has been changed to overcome this challenge. So that would be a point of departure to go into the formation of BC funds or BC firms. I would say the organization and the main tasks that we used to have or address are mostly 5, but the first 3 of them are the most important. To raise capital, the fundraising stage is quite demanding and time consuming. We need to address and to structure funds that would have a sustainable long-term in terms of the money being committed from LPs, different LPs, individual high net worth individuals, as well as family offices, and in some cases, corporations in Latin America, to commit using a capital call scheme for the first 5 years to invest, and then all the investment process, as well as the smart money that we bring in together the portfolio companies. We need to screen a large number of business plans. That would be another task, and to identify that would be the challenge, a huge challenge. The few ventures likely to succeed. We face here the main challenge of large numbers law, in terms of that we used to have only some of a portfolio, for instance, of 10 companies, only 2 or 3 are going to be successful, and the other 4 or 5 just multiply our investment for 1, and 3 or 4 sometimes we got in bankruptcy or fail, I would say. So screen accounts for almost 50% of our tax during the structure or the organization of our BC funds. We need to add value to the ventures, to the target investments in which we invest, in terms of networks, in terms of strategic insights to the entrepreneurs, to the founders, as well as to bring different assets like human capital to the teams. Sometimes they only have, the technology guy, but they need to have the commercial guy as well as the financial one. And finally, we need to adapt we are on a technology landscape, so we have every day we have new information, new opportunities, so we need to be resilient, as well as be able to adapt to this kind of changing information and opportunities. We used to use the limited partnership structure. We don't have the similar one as the developed countries in Europe or the US, but we share the same goals in terms of a limited liability for LPs, for investors. We have a finite life of 10 years, and we need to allocate returns in some way that align the incentives between the GPs, the fund managers or general partners, and the LPs, the investors. So the general partner, as we call GP, is the one that organizes the fund and is responsible for raising the investment capital from the limited partners. And as well as a fund manager, we deploy the capital by investing in portfolio companies, selecting them, screening them, and also bringing network insight, strategic insights to monitor until we get the stage of harvesting. Just to have a picture or an overview of the organizational structure of venture capital investment, there are a lot of literature and experience that I'm not going to go deeply on that, just you have a first flavor of how we structure the GP, the LPs get together in this venture capital firm or fund, okay? And how we structure the economics incentives between the different partners get involved. I placed Corfo as another stakeholders, key stakeholders in the case of Chile, in the Chilean market, but we have the same public-private partnership in Mexico, Colombia, in Brazil, Argentina, as well as recently in Peru. But you can see the economics between the GPs and the fund in terms of we used to commit some resources around between 1 to 5%, depending on the size of the fund. We get from the fund an annual management fee as a compensation, a fixed compensation for all the tasks we get involved, between 2 and 3%. Mostly we have this structure of 2 and 20, and the 20% coming from the success fee or carried interest as a way of align the incentives and trying to get the maximum return for the limited partners. Okay, so using as a threshold or a hurdle rate of, I would say, between 6 to 8% as a minimum return for the LPs, all the additional returns from that threshold, we share 20-80 between the GPs and the LPs. From the bottom, we have the limited partners that commit resources on a capital called scheme to the fund, and we assume a capital appreciation of between 70 to 80% of gain. And from the other part, most important, the target investments, the portfolio companies, we structure a diversified portfolio of different real companies, startups, or growth companies to add value to them or create value. But we get from them the financial claims, potential financial claims in terms of the upside we are trying to get from the value creation. Okay, so Corfo is going to be one of, as a public-private partnership, one of the key partners in this game. Just you have an idea of the economics. As an example, for the returns to GPs, we can consider a target fund of $100 million with 5 GPs or principals of GPs, the partners of this fund manager, and assuming a 2.5 of management fee and 20% of carried interest, we can have from using or assuming a 10-year life for that fund and investing regularly per year $20 million with an average holding period of 5 years, an annual return of 20%. That would be a very conservative expectation for a fund. You can see what would be the management fee regular per year, 2.5 by the size of this fund. That would be annually 2.5 million or 100K per GP, and from the success fee or carried interest, assuming that we're going to invest on the first 5 years of this 10-year life fund, from the year 6 up to the 10, we are going to get, using that carried interest of 20%, around of $6 million, or $1.2 million per principal. Okay, so every figure from this example are per year for sure, and it's not being considered the expenses we need to have. So we need to take into account all the legal auditing as well as the compliance or the back office expenses we used to have as a minimum in a fund as a general partner. Okay, so we used to have a progression regarding the returns to the stakeholders, the LPs, the GPs, as well as any other partner like Corfo. In that case, Corfo, if the fund is going to be successful, is going to perform like a senior debt. So Corfo pays first in any liquidation stage, and then you have the progression of, first of all, LPs, the principal, assuming a hurdle rate of, for instance, 8%, and then the GPs, the GP actually in terms of the carried interest. We used to see, every VC firm used to see these structures as a contract-based approach in terms that we used to manage different long-term contracts between the GPs and LPs, the GPs and Corfo, for instance, in terms of a long-term loan, and the most important, the contract relationship between the fund, the VC firm, and the entrepreneurs, the target investment or portfolio company. So the most important is reputation, and for every agent involved in this process, GPs, LPs, as well as the entrepreneurs. And we used to have, from the very beginning, the pillar, the main backbone of this structure would be the venture capital limited partnership agreement between the GPs, the general partners, the fund manager, and the investors of this fund. We need to know the rights and liabilities we face each party within this long-term relationship. So we need to structure, and this issue is going to be covered by Josefina Yavar next Friday, but that's why I'm not going to go deeply on every term and the trade-off we have between different issues involved on these commitments, the capital calls, and the reputation as an outcome of this role. But just you have a snapshot of this process. The VC investment process used to be this way in terms of the timeline. We have the development of the fund concept. We need to have a business plan in terms of the investment thesis, as well as the rights and obligations we face as principals of a GP, a fund manager. And then we need to secure commitment from investors, the fundraising stage, until we closed the fund. We can have different closings, but that would be the first step. But from the very beginning, if we have pretty clear an investment thesis, we need to generate a deal flow to start pretty fast on a first capital call from when we just put in place the money and the investment committee. That would be the governance, the most important governance of a fund, to bring together the decision-making process to screen business plans from different entrepreneurs, different startups, evaluate and conduct due diligence and place or bring investment memos with a recommendation to invest to the investment committee on any company, any startup. We need to negotiate deals and staging, and we can have additional capital calls depending on the follow-ons or on other investments we are going to launch for that fund. Okay, so that would be around 2 to 3 years, and between the second and the third year, sorry, and the fourth and the fifth year would be the most important, the heart of a fund, the value creation and monitoring of a portfolio of assuming 10 companies, okay, within this fund in terms of different issues or different tasks and responsibilities like the board services, the performance evaluation and review, recruit management, assist with the external relationships, among others. And finally, I would say the other heart we have is to be successful in the harvesting of our portfolio companies. In Latin America, mostly the exiting stage would be an M&A, global M&As or regional M&As from different corporations. When from the very beginning we start doing B2B businesses from our portfolio companies with corporations, we are targeting a potential exit within that relationship, long-term relationship with any corporation. So we used to target, even though we are not get rid of any other potential exiting or harvesting like an IPO or other kind of exit process, we used to have Pareto law here in terms of 80% of our harvesting would be global or regional or local M&A from corporations. And finally, the distributing proceeds in terms of if we are going on capital gains, depending on the multiples of this process, or any dividends, that would be an exception. But we can have DART as well as any swap, share swaps between companies. Okay, that would be another alternative. I bring just as an example of a timeline in the case of the Chilean market, the Chilean BC market. Here you have, in terms of the timeline of to apply for a BC firm, that would be an additional process we need to get involved if you need to have a matching fund from private money coming to a BC fund, and getting money from Corfo. Corfo backing almost 95% of the the Chilean BC's funds. Here you have almost up to 6 months in terms of the application process and all the chart flow we have for the BC fund Corfo credit line application process up to the end. In the case of we as a BC be successful getting a credit line approval of 1x1 or 2x1 or 3x1, depending on the program being supported by Corfo. As any other fund, we have a limited partners capital call flow. The chart flow goes from after the Corfo credit line approval. We need to start doing a lot of governance task in terms of getting together the shareholders general assembly and putting together all the investment committee members, appointees, and also the surveillance committee that would be the second stage that approves any decision-making process of the investment committee. And finally, the first investment committee meeting to decide on any target investment. Okay, could be one or more than one company on the very beginning. Okay, in that process, the GPs needs to lead that capital call in terms of delivering letters to the LPs and also getting the money from Corfo, matching depending on the program that supports that BC fund, 1x1 or 2x1 or 3x1. But the general partner, leaders that in terms of matching the capital call from the investors, from the LPs and the Corfo money. So we are ready to go or ready to deliver the investment package to Corfo. And in that case, we need to follow this process. Even though it looks like very bureaucratic, Corfo is one, as any other development agency in the region, is very, it's pretty fast, the process. It's not bureaucratic. We are going to have one of the GIF from that unit from Corfo on the 4th session. So they are going to address and talk about in detail about the process. So in the case of the Chilean BC market, in the case of a harvest stage, we are going to have an earnings due to a portfolio exit. Okay, assuming that we are selling out any company or the whole portfolio companies, we need to take into account that we have a process of paying out, because it's a non-recourse credit line from Corfo, it performs like a senior debt. So we need to pay in advance in any proceedings we get from an exit. First of all, the credit line, the principal, as well as the interest, is assuming is a T-bill, a Chilean T-bill that today performs less than zero, is minus 0.2. So if we sum up the contingent interest rate of 2% plus, it's not actually today delivered, because in the case of the Chilean economy, our T-bills are performing below zero. It's around 1.8. So we need to pay, first of all, as a senior debt, the Corfo loan, and then the progression goes down for the LPs. Second of all, the investment and the hurdle rate of 8% if everything goes well, and then you have the profit sharing between the LPs, 80% of any surpluses, and the carried interest going to the GPs. That's why the colors between Corfo, first of all, then the LPs in blue, and finally yellow, the carried interest of 20%, assuming that figure for the GPs. On the right-hand side, you have the economics, the basic economics of 2.5% for the management fee, the regular annually fee for paying out for the performance of the regular task of a GP, and the carried interest paying out the performance in the case of a successful portfolio exit. Okay, one of the other tasks we need to take into account is the trade-off between this equation between the expectation, the return expectation we have, because we are on a highly risk market, and how we manage that risk or diversify. How we do that here in the region, as well as in particular in Chile, we use at least 5 pillars in terms of our way to overcome and diversify our portfolios. In terms of stage, we used to structure within a fund or in a portfolio of funds, different stage, focusing on seed, early stage, as well as growth stage companies. That's one way to address the risk management and diversify. Second of all, industries. Sometimes in the region, in Latin America, we have an agnostic view, but during the last years, there are a lot of new funds, VC funds, focusing in a specific vertical, like health tech or fintech or clean tech, okay, or agtech. But anyhow, we try to be as broad as possible to manage the risk in that sense, because we don't have too many entrepreneurs and as well as the startups in different segment or verticals. So we need to have a broader view on that. Third of all, the region. We need to have different jurisdiction, not only Chile. In that sense, Corfo has been changing its policy to allow to invest abroad, with not too many restrictions on that. So we need to have a broader view on the region, not only in Chile or in some other countries in Latin America. Instead, we need to be as global as possible for that purpose. On the fourth, we need to have different ways to invest in terms of the investment tickets, in the size of the sales of our companies, a small one as well as medium size. And in that sense, the effect would be the investment ticket. Finally, we're investing in average between $500,000 up to $3 million. That would be the range, even though we are open to invest more than 3 or less than $500,000. 5, the entrepreneurs. We are agnostic in terms of even though the serial entrepreneur has more, would be more, they have more chances to be successful. We need to have first-time entrepreneurs as well as corporate experience. That is a value added for any portfolio structure. And finally, and last but not least, the co-investment strategy. For us, the syndication process would be a must in terms of the diversification. We will see that the co-investment experience in the Latin America has been very successful, leading in any BCs, large BCs, leading the rounds or being a follower. Again, it's quite important how we structure or build a portfolio. Here we have an experiment, or not an experiment, it is the evidence we have for a bunch of different BC companies in the region. And you can see here that investors or BCs with around 25 companies portfolio have 4.5x the RRR and 1/12 the variability of returns of those with smaller company portfolios. Okay, so being larger or trying to have a larger portfolios would be better than have smaller ones. It's pretty straightforward, but it's important to have the evidence that diversification drives higher and more consistent returns. Okay. As another example, summing up, if you sum up 3 main leverage, the main components would be to have a process of getting or using an accelerator managed deal flow, assuming, for instance, 60 companies within a batch, provides for any BC funds a double down investment strategy. And we have evidence in Latin America that would yield an estimated of 4.8x enhanced return using that. Only the accelerator managed deal flow, getting the best of an accelerator managed deal flow for a fund and doubling down on them, also getting more money or going on a follow-on investment strategy with the best of the class of any batch of an accelerator management deal flow would be a must or a minimum condition, a necessary condition to be successful. Additionally, we have an international market arbitrage between the emerging markets like Latin America and in particular Chile, and the developed markets like the US or UK or any other country in Europe. We have evidence that yields an estimate of up to 4.5x valuation arbitrage between LATAM and the US markets. Similar figures for Europe or other developed markets. And finally, if you bring a core for leverage or any public partnership, a private public partnership, using up to 3-by-1 matching funds, assuming, for instance, capital commitment from LPs of $8 million and $24 million coming from Corfo, would bring additional leverage and also could or should lower the risk for LPs by doing that. If you sum up, for sure, you can, it's a necessary condition, not a sufficient one, to be successful, but you can manage the best way the risk, as well as to get a potential return. Going deep on the accelerator, here you have the evidence. I'm not going deeply on that. I can share the source of this information for at the end of this webinar, for sure. Here you have the arbitrage evidence, valuation arbitrage between LATAM and the US. Here you have between two stage or two rounds, the seed one and the series A. Between LATAM and the US, we have getting together the 11x and 2.5x. We have in average a 4.5x valuation average, an opportunity to invest in a similar startup here in Latin America. They are cheaper, I would say, or undercapitalized in Latin America. So there's an opportunity to bring them, the Latin startups, in early stage or seed stage, and position them for subsequent races in the US or in Europe. Okay, so that would be the evidence in terms of how we manage the risk and how we overcome that equation between returns and risk in this alternative asset class. I bring this equation, or the tyranny of the average of the BC markets, not only in the Latin landscape as well as in the developed markets. We have these figures. Out of 10, 3 would be potentially blockbusters, so with a multiple of 10x. 3 out of 10 would not yield anything, so you can get back the investment, 1x, and 4 out of 10 would fail, okay? So we need, in every decision, investment decision, we need to target investment that has, from the very beginning, a huge market size, potential market size, because that's the only way to target or trying to address these statistics, okay? So it's a way to say that in average, 6% of portfolio investments regularly accounts for 60% of returns. So that would be the way to address these statistics. Not only we need to address the startups that should or could fail to avoid that, but anyhow, the only way to have blockbusters like more than 5x, it's to target companies that has as a business plan huge market size. They, from the very beginning, look globally the market, okay? Another way to decide which would be the best or the target industry is to use the Boston Consulting Group matrix in terms of at least the market growth and market share of different industries. Here I brought only an example: services, specialty, retail, and industrial, to have an overview of what would be the more sexy sectors. To, for instance, to go on healthcare or medical device, fitness, that would be an approach, or mining suppliers in terms of technology that approach the mining sector, the healthcare sector, the fitness. Any other sector, in the case of the Chilean market or the Latin America, would be interesting, but or they could have more competition, or the market growth is pretty low. So we need to balance this information in terms of what will be our investment thesis as well as our target investments. What would be the main value added of BC and the GPs, the fund managers, using the Gompers study, even though Gompers is updating this quite interesting study of how do venture capitals make decisions. Mostly the most important activities we used to do and in time use would be the sourcing deals. That's quite important. That would be our heart, the heart of any VC firm, assisting portfolio companies. Everyone needs, even though you could have serial entrepreneurs, they need to be back as well as advice in different issues, strategic ones as well as tactic ones, and networking for sure. We need to be connected with the whole ecosystem, depending on which you are based. But today it's quite important to be doing networking globally. So depending on the stage you are, early or late stage, mostly the three most important activities accounts for sourcing deals, assisting portfolio companies, and networking. Going to the co-investment or syndication strategy, we have from the last 4 years in Latin, we have a lot of footprints in terms of the syndication between regional funds, VC funds, and global VC funds. Here you have the huge boost we have between 2017 and 2018, from around $600 million to up to $1.2 billion in terms of the money or getting together in a co-investment strategy. So you have here CASEC, Angel Ventures, 100 Startups, Redpoint Ventures, Monachis from Brazil, Dila Capital from Mexico, among others, all BP, quite important. So why it's quite important, the syndication or the co-investment, is just at least 4 reasons. Pool VC human capital. We need to address the diversification of our portfolios of different VCs. Is a way to get a barrier to entry of new VC firms on the better deals, and for sure, in our case, reduce informational asymmetries. Sometimes it's quite important, even though you are doing a very tough and very deep due diligence process, it's quite important on that stage as well as on the investment stage, operational stage, to reduce the informational asymmetry. So 4 eyes looks more than 2 eyes. So that's why partnering and doing syndication with other VC firms is quite important. It's a challenge for sure. We need to build on trust on the community, but today is a must for sure. Our business, I would say, that's why on the right hand side we have a livestock. You can have a trade-off. Our business is meat, actually. We need to grow the livestock instead of having a very nice small and medium enterprise business, getting milk from that cow. Instead, we are going to the upside. Wagyu livestock would be for us the target or the best outcome in terms of our business. Even though it's an alternative to have a milk industry and it's good enough, it's a dividend yield business, and instead of that, the BC industry would focus on the meat industry for sure, growing that nice cow good enough to get the capital, a huge capital gain. So in terms of financial economics, it's like a call option, is with a limited downside and significant upside. So I'm gonna go very quickly on the BC or the contract-based approach of the BC firms. Quite important, and the heart and the backbone of our main task would be to design the best contracts between the BC and the target investment, the target companies, in terms of different issues that we bring together in a term sheet as a way to approach from the very beginning the main conditions and provisions that we need to put in place in the stock purchase agreement, as well as the investor rights agreement. But anyhow, if you are investing throughout a convertible note or instead equity in a later stage, you need to put together the staging, how we are going to have, we're going to place put options or demand registration rights or any preemptive rights and right of first refusal, among others. So placing together a very complete term sheet in the Latin American landscape, it's quite important to align the incentives from the very beginning, and to avoid any surprise within the next negotiation stage, writing down the stock purchase agreement or the investment rights agreement, depending on which would be the stage. Josefina, next Friday, as I already mentioned, is going to address these different issues in detail. So if you have any question, for sure, we can share that. I already addressed this point, the contract between the BCE and the investors. It's quite important to address different issues within the venture capital limited partnership. And it's key to address the expectations on the responsibilities, the tax and liabilities we face each party. The GP, in the case of any other public organization like Corfo, for sure, we need to put in place that information from the very beginning. I'm not going deeply on, because I already addressed some of the economics, but it's quite important for all the principles of a fund manager, or GP, sorry, to put together all the information and the assumptions, even though they are assumptions and we are placing sensitivity results under different assumptions, and reality sometimes it's quite different than the expectations, but we need to have or put in place this information in terms of the structure of the fund, what would be the LP commitments in terms of LOIs, letter of intents, as well as the GP commitment, capital commitments, what would be the expenses, and what would be our economics fundamentals in terms of the management fee, the current, as well as the timing of how we invest and how we expect to harvest our portfolios, assuming different multiples, fails and successful, or okay. So going a foot ahead in terms of this stage, I would say that the BC investment decision making, as I already mentioned, has, in terms of the time use, the sourcing would be quite important, the deal execution in terms of conducting the most efficient due diligence process on the startup or target investments. We need to analyze the market, the size of the market, the potential of that market, any financial projection, and also negotiating the deal terms. After that deal execution, we need to go into the integration process. It's like a marriage. So we need to have this alignment between the incentives between the startups and the founders and the VC and their principals, in terms of how we add value to them in terms of the portfolio company support. And finally, the last three activities in terms of networking and brand building for the VC, as well as fundraising and LP relations, are quite important, as well as the internal operations. Mostly, the most important are the main three. As Ataria Ventures, Juan Pablo Ortiz, one of the leading VCs early stage in Latin America, pointed out, in terms of the difference between the activities on the Latin VC firms and the US or Europe, ones, we have a trade-off there. The main challenge in our region would be to find high quality deals. That would be a huge challenge still. And in US and Europe would be to find out the better network and being able to match startups seeking capital. That's the difference. Even though we are adapting or bringing the developed market experience to the region, we still focus on finding out the high quality deals, because we have a lack, even though Latin America is getting pretty well, is doing pretty well on bringing new founders, one of them serial entrepreneurs with a very spectacular footprint in the global market. We don't have the figures or the scale of developed markets. So going towards if we split out the investment focus on pre and post investment, we have the deal flow and the investment selection first of all, and then the startup growth and the harvest one. So we're going to go on that. I'm not sure if we're okay on time. So first of all, the pre-investment. Here's a lot of technology that is coming to the VC industry in the last 5 years, bringing deep technology to this sector, trying to find out or screen the better deals within a market, Latin America or Europe and the US. That would be quite important, and it's the point of departure for the whole process in terms of going to up to the negotiation stage, in which we involve the advisory boards, the venture partners, and the most important pillar in terms of governance within the VC firm is the investment committee, in terms of the investment decision making. Okay, so how do VC seek their investments? Almost 50% is a professional network. We rely on professional networks. It doesn't depend actually, even though we have difference between early and late stage, mostly proactively self-generated and professional network would account of around 50% of the deal flow sources. Even though it's quite important, the quantitative sourcing using technology base, today that would be the figures, okay? So we need to be very proactive in terms of finding out, getting connect with other partners within the ecosystem, and also professional network. There's business angels as well as accelerators that bring those deals to the VC firms. And in terms of the VC decision-making process, there are important factors for investment selection. Even though there's a bunch of them, the high-performance team profile is quite important. The team accounts almost for 90% within the industry experience, entrepreneur track record. So we look around those qualitative and quantitative figures in terms of the CVs of or the business plans of any startup. Industry experience, entrepreneur track record, skills. Even though passion is quite important, we need to go and to have a psychologist eye to look around entrepreneurs that you can feel that has the grit to overcome any problem, and we need to have those entrepreneurs and founders within a portfolio company. But anyhow, the more objective figures or information regarding the industry experience as well as the entrepreneur track record and the skills would be the most important. And the other information for sure is the product market fit as well as the business model, how they get the money or earn the money. Valuation, it's key. Sometimes Latin entrepreneurs feels that they are in Silicon Valley, but they are in Chile. So we are not allowed to invest in a napkin with a pre-money of $5 million. So we need some traction. We need a product market fit as well as a validation, commercial validation on that target investments. We used to talk about how we deconstruct our decision-making process in terms of targeting at least 5 T's. We look around teams, very strong and strength of on those founders. That would be key in terms of different qualitative and quantitative characteristics. I would say mission-oriented, obsessed with their companies, relentless and determined would be key, but it's a necessary, not a sufficient condition to be successful. We need at least the 4 other T's of tech. We are looking for tech-based companies to scale fast and to make of that product or service a product market fit or a service market fit. The TAM is quite important. The total addressable market would be a key. The commercial traction or commercial validation would be key. And finally, barriers to entries, I would call the trenches, would be one of the key factors that determine our decision-making process. Just as an example of different maps, market maps of companies within the EdTech, AgTech, and FinTech in LATAM. Here are companies that are already consolidated in some way, I would say. For instance, you can see there on the bottom, the Notco company in the innovative food products or food tech, I would say, segment within the AgTech. On FinTech, you can see around Conecta AP from Mexico, as well as in Chile, you can see the Kipu or Punto Pagos, as well as Blinking, among others. Cumplo and Red Capital already doing the soft landing in abroad, in Mexico, as well as in other countries like Colombia, among others. So here you have a sample of consolidated startups in different stages. Here are the outcomes. So we need to go back and see how efficient we can screen the best of the class. And the machine learning approach to BC is being around for a while. Here you have an approach from Carnegie Mellon that is bringing together information, that huge database of Crunchbase and TechCrunch data on companies from the 70s up to 2007. And we can use those factors that predict the success of startups with up to 80% of certainty, okay? So there are a bunch of information I already pointed out in terms of the main characteristic of the entrepreneurs, the market, the TAM, as well as the traction, etc., etc. On the exploratory stage, depending on what is the source of the deals, would be general or our partnership. For instance, any investment banking or a lawyer firm that bring us new deals. In any case, we need to go very fast in this preliminary analysis, going deeply on the startup and the entrepreneur team, main characteristics and market analysis in less than 2 weeks, okay? We got the information request, it's reviewed. The first meeting, we need to look at each other because this could be a medium-term marriage. So we need to have this kind of, quote, bonding between the VC and the principals and the entrepreneurs. And finally, bring that information all the analysis to the investment pre-committee. Is a early stage before getting to the investment committee, the BC investment committee. But in the case of the partnership, the difference is that we need to have as an outcome a pitch day that would be a way to decide between different, a funnel of different startups. Okay, we write down a memo, an investment memo. After that, this stage in which we at least address 3 issues: opportunity in terms of market, competition, the innovation level of that startup and the entrepreneurs, the business model. Sometimes we use Canvas as a tool to decide what would be the value proposition, what would be the key elements or features within the value proposition of the business model, and the team. So we spend a time on our investment analyst as well as the principals writing down investment memo to the investment committee regarding those issues. Okay, that would be a way to select using your webpage, a call to action, bringing those startups that are seeking capital to do the application process on the BC fund. Going to the investment selection, it's an iteration process in terms of the research, deal structure, going back and forth in terms of the internal pre-committee, and we reach out to the investment committee in which we present a summary of the opportunities, like you look here in terms of using some of the tools of SWOT, to look around the best opportunities, and in that case, analyzing using a pitch deck roadmap in terms of the weights on the vision, the product, the execution, and growth, for instance, and technology for sure. What would be our engagement? We have venture partners as well as investment associates and advisors in that stage to have a pretty efficient and straightforward decision-making process. We in this stage, when we have the green flag from the investment committee, we get into the due diligence pretty fast. We need to gather information financially, the product as well as technology. If they have any patent as well, we need to supervise or analyze that information. In that case, we use legal partners, legal advisors to do that, to address this due diligence stage. And finally, you can have here as a sample of the funnel. If you got, in the past, we got 120 first touch-based project or startups. Finally, we closed in this process only 5. So it's a very, very tough process. It's the natural way to approach a very competitive one, because we have a scarcity of resources, so we need to select the best of the best. Since Josefina is going to address the term sheet in detail, that would be from the very beginning. We place the main conditions that is going to be write down in a shareholders agreement between the BC and the startups. So term sheet address or set out the main conditions of the deal in terms of the information regarding the founders, the investment, any provision like liquidation preference, voting, the governance structure, as well as the vesting, if we need to put in place some amount of shares to key players like the CDO, if it's not already being appointed, among others issues that are key on this stage Okay, the term sheet, it's one of the key tools to align the incentives and between the VC and the founders. Just you have a very neat or overview of how we price the ventures. We used to approach asking out different questions in terms of if we are going to make the evaluation, if we are going to invest using an equity round on expect future cash flows, or which would be the best cost of capital using it as a discount rate for these startups. We have different questions we need to address, but we need to be very straightforward in terms of what would be the way we are going to analyze, depending on the dilution, potential dilution on next rounds, or if we are going to have multiple financial rounds. Depending on the assumptions, I would prefer to have a sensitivity analysis, to have a range of what would be our shareholdings on the company, what would be the optimal investment ticket on that company that they would need to address the business plan actually for a two-year period, for instance. So that would be the method. Just in a nutshell, if we are contemplating a 3.5 million investment, the main question is what would be the share price using this assumption. For instance, if the company is expected to earn at the end of our time period, if we are going to hold this company for in average 5 years, and we expect using future cash flow of the business model at 2.5 million in earnings, and we have information like Damodaran, for instance, information of comparable to companies of PE, price earning ratios of around 15, and we expect to go on a harvesting on an M&A, local or regional or global M&A, assuming we are going to sell out the whole, the complete share, 100% of the shares, and we are going to use as a cost of capital of 50%. That would be the RRR we expect for that risk. And there are 1 million shares outstanding before the investment. The key in that exercise would be what would be the share price that we are going to get. And in the other outcome of this exercise is to have an idea of what would be the equity stake. In that case, of course, is a huge figure, 70%. That would be the outcome. You can have as an idea that as a VC firm, we used to have minority equity stake in every company, less than 50%. Even though we are investing these kind of figures, $3 million, that depends on the stage of the company. In the case of a seed company, regularly we invest less than $1 million, but with an opportunity or an option to do a follow-on investment, okay? So I'm gonna leave there this exercise, even though we are sharing with you all this information as well as the spreadsheets. You can look around and we can have we can answer any question regarding this issue. Here you have more on that, going deeply on a sensitivity analysis, variation of depending on the time to exit or the RRR, what would be the main drivers of the venture capital method, how we price these investment opportunities, okay? So for us, it's quite important because we try to invest in the whole range of from seed up to growth. We are able to invest using convertible notes. I would say actually or convertible notes or equity. Safe in the case of our regulatory conditions we have in Chile, it's, we are not able to do a safe, but actually safe, we can be very, we can change some provisions of unsafe and put that safe as a convertible note. So in average, we used to invest or equity or convertible note, depending on the stage of the company. And if we are targeting a convertible note for a company that they just have the traction, they already start up, and they are on a seed stage, we have different benefits or advantage using a convertible note, or I would say it alone. But since we are on venture capital and we need to have an equity stake on our portfolio companies, we need to have a convertible note. We need to have the opportunity to convert that note, that loan, in capital, in equity. So when we use convertible note, depending is pre-seed or early seed or a bridge funding, we use this tool, this financing scheme, and we need to take into account different issues. The valuation cap, so we need to have a threshold, a floor, I would say. It could be post or pre-money, depending, in which we are going to convert our loan in equity stake. We need to take into account in terms of the note, the maturity, in how many months or years we expect to convert that note, and conversion conditions, depending on what would be the milestones we are going to use to convert that note, that debt, into equity, the discount. Are we going to have some benefits, some discount on the, for instance, if the milestone is the round A, if we are going to have in 2 years or so around A, we need to have a preference in terms of the value we are going to convert our loan into equity with a discount. Regularly, we use 20%, and regularly we use around 2 to 2.5 of multiple, or implicit the RRR. If we're going to early exit, someone is going to pay out or cash out our loan. Okay, in that case, we need to put it in advance, place in advance that multiple. What would the VC firm expect to have in the case another VC or private equity is going to cash out on that? And the main goal for obviously a VC aligned with the startup entrepreneurs, the founders, is to convert it in equity. We are seeking to test an idea or bridge a gap or make a quick investment. It's more straightforward than an equity stake. We have shorter legal documents, lower lawyer fees, that would be quite important, among other issues involved in this convertible note. Equity round, on the other hand, when we used to invest in companies that are ready to get equity stake. Okay, so they are on early stage, they don't need a bridge gap, so we can price the round because of different issues beforehand, because they already have, they are being priced on other rounds, pre-rounds, but we need to go deeply on shareholder agreements. We need to structure a governance that will be efficient and align the political and the economic rights for the minority equity stake for the VC, and it probably is likely to take longer to address different legal as well as the valuation discussion. The pre-money, what will be the real pre-money price? We need to price correctly that company. Okay, and there are different types of shares: common shares, preference shares, and the the shareholder agreement would address that issue. Okay. I'm going to jump to the startup growth. When we close and the investment, we get involved as I would say a marriage. So we need to have the bonding condition to go into and define and design the best way to add value from the VC to the company. Okay, so we need to analyze the process flow, the decision-making roadmap, the business plan is quite important. How we are going to analyze and monitor the main milestones of the budget, for instance, or any other issue. So it's an iterative process in terms of how we integrate to the company. In terms of sales and marketing, financial, research, and strategy, it's quite important. So we need to place in that governance different stages, like committees, like financial or commercial committees, as well as the board, for sure. But we need to have open doors, open windows as well from the startup point of view, to get information, to add value from the VC, to bring new deal flows in terms of commercial, network, as well as insights, strategic insights and tactic insights. How we involve, I'm using as a framework examples of VC here in Chile, as well as abroad in Latin America, but we used to implement this strategy in terms of company visits, investment reviews, investment committees. We used to review frequently the main figures, the main KPIs of the company, and the most important governance is the board of directors of each startup. Okay, but the information has to flow up to the investment committee of the VC fund as well, using the investment reviews. Okay, so we need to get together with the founders from the very beginning and agree on the main KPIs we're going to follow and monitor. Okay, that is quite important, and we need to have or put in place a key account manager for every company. Okay, that follows and monitors all those informations. Okay, here you have some of the information regularly there that we ask, and on the visits frequency, the key areas would be strategy and sales that we need to place, put an investment associate as well as a balanced scorecard, and finance. That would be the tools we use to regularly use for backing, monitoring, and management control on each startup company. Here you have a balanced scorecard, a regular balanced scorecard on a software as a service, for instance, in terms of the MRR, the monthly income of this company, and other information. We used to overview the strategy implementation and the outcome measurement. That would be key to align the strategy and sales and the commercial side, and the management control and finance. The board of directors, it's quite important. We need to have at least a seat on the board of directors, at least one seat, and to have the political and economic control or rights on that board, and to get involved on the strategic decisions. And we need to bring this information to call the attention on the other board members, as well as the CEO of the company, or any other key founder or other key guy in the company. We used to use standards board meetings for every company in terms of just to be very efficient and straightforward in terms of the overview, and follow the CEO commitments, the board commitments, as well as the financial status on the main KPIs, and some industry comments. Just to have no more than 10 slides to be very efficient on any board of directors and a strategic committee, if that would be the case, is another governance instance to analyze other issues on a macro level. But it's quite important to have the information right away to analyze an overview. That will be the involvement in every startup, a venture partner, a strategic committee, and the board of directors, depending on if we are going to have 1 or 2 seats at the board of directors. We used to use different tools like the BC's SaaS software as a service, like CRM, deal flow, to get information from deal flow, portfolio reporting, getting information from the company, as well as reporting to the LPs. There's a bunch of different alternatives. Subflow would be one of the recommendations, Affinity, Prequin, etc. And at least the last but not least, the harvesting for us is quite important. We have different alternatives. Here you have an example of the top 25 VC-backed exits of all time in IPOs, as well as M&A, global and regional M&As, depending on the size. But we have in LATAM, I think the most important is private sales. M&A would be because we used to start from the very beginning in our portfolios a relationship with corporations in any vertical, and that visibility from the very beginning start to grow and develop, and we target one of the issues, most important issues that we need to take into account when we decide to invest in a startup is to have a clear exit strategy, and 80% of the time is a private sale, okay, global or regional M&A. Even though we have other choices like roll-up IPO or sale of the business to the employees, like using an ESOP, or continue operate the venture. That would be a choice, but in our case, since we have a time constraint of 10 years, we need to find out very quickly what would be the best way to approach the harvest stage of our portfolio companies. So I'm gonna stop here. If you have any question, I'm gonna leave enough time to open the floor to questions and to have a discussion regarding this session. Thanks a lot.
Thank you, Rodrigo. Thank you for all the valuable explanation. We have a lot of comments.
You want me to just...
Steve, if you can read them out loud would be great. I know a lot of people have doubts, so we can wrap it up after we have answered all the major questions.
Sure. I'm not going to be able to read all of them because of time issues, but I do like this whole process. Guillermo, you can hear me, right? That means everybody else can. Okay, good. Yeah, very active. So what I've been doing is, Rodrigo, while you've been speaking, I've been answering some questions. So if you want to peruse or review some of the questions that I've answered and give your own response, why don't you go in there while I'm talking and cherry pick and just let me know if there's something in there that you'd like to tackle. I will choose a couple that I think are really important. The issue, I think the first question asked by Aki is very important. This is an ongoing issue, you know, as to what founders can make, is, you know, cash compensation, what is reasonable. And, you know, my answer basically said, you know, as an investor, the thing that I'm most concerned about is the psychological welfare of our founders. And if I see a founder that, you know, let's say we're talking to somebody, they're 22 years old, you know, they don't have the benefit of having built up a big cash position because they worked in corporate world for a while. You know, I don't want to see a 22-year-old with their credit cards maxed, you know, and they're almost homeless. That's not a person that anybody should invest in. They need to kind of take care of their personal finances. So that being the case, we'll have a very serious conversation. What is it that you need to, make your monthly, needs every month, right? And if we're comfortable that's a reasonable number, we'll invest in that CEO, in that founders team. But don't expect to get market rates. And we've run into, Rodrigo could talk about this without naming the name, but we just passed on an opportunity down in Santiago, and a wonderful, wonderful ag tech firm. But these founders had unrealistic expectations. Didn't work out. Well, these people, no one's going to invest in them. So we walked. So that's an example. So skin in the game means personal sacrifice, but it doesn't mean that you should put yourself at risk. Be very candid with your investors. That, hey, as long as you're okay, and they respond. It's important. We want to take care of our founders. They shouldn't be starving to death. I thought that was a great question. What about solo founders or couples as founders? Listen, a solo founder is a bad thing. Everybody sees that. It takes a team to do something that's nearly impossible, and every startup is nearly impossible. They're all hard. If you're most likely to fail according to the statistics, then you want to surround some people around you. It's nice to have somebody to encourage you when you go to work every day. Together. Think about it like that. People found have lots of experience with that, and it's always been positive for me. But I consider it's a couple. They're dynamic between them. We go a little bit slower there, so that's important. I don't think it's appropriate for couples to be poor because, which asset class does one part of the couple represent versus the other? Board members usually represent an asset class or stakeholder class. Like you have the common shareholders. Well, so both couples will represent the common shareholders. You have the preferred shareholders. You have an outside investor. These are things that are kind of concerned. So that kind of breaks down. Other than that, I really don't see a risk in this at all. What about exit? IPO. It doesn't, in your dreams, IPO is highly unlikely. Most likely these exits come by merger acquisition through a strategic or somebody in your B2B network, somebody like that who's using your tech or using your service. Anyways, Rodrigo, is there anything in there that you fancied to answer?
Yeah, thank you, Steven. Do you see any difference in exit success between B2B and B2C startups? The thing is that the process of a B2B startup is quite different. If it from the very beginning it's engaged with corporations or a set of corporations, you can have a likely M&A process on them. One of them. We have some experience on the energy sector. Bringing or engaging a startup from our portfolio with different energy corporations, and that would be a path that likely would bring a successful exit on that. On B2C startups, you can see more a regular path on different rounds. I would say like Mercado Libre is a long trip to reach or global M&A finally, or an IPO like Mercado Libre did. Okay, but you need to burn in that case regularly a lot of money to reach out that outcome. So in our case, we used to be biased towards B2B startups because we have a more clear path towards a potential successful exit. B2C, even though there are plenty of examples of successful examples, you have a very tough road on that.
Hey, so thanks, Rodrigo. I didn't give Matt Wunderly a complete answer on a question regarding timeline to exit. I didn't actually answer the timeline issue. I answered it in another way. I just to say, hey, if you've bootstrapped your offering, you're going to get a much better valuation. As far as timelines to exit, I think as a founder, you should brace yourself for a 5 to 7 year journey. You really should. It's going to take longer than you think. It always does. There are very few exceptions to that. And so with that said, you know, if you realize, oh, I'm going to make less money than I would normally make because I'm the founder for that, you know, if you're in a family situation where you have children and all that, you know, they're on that same ride with you. I just got the clarification from Maximilian saying that Aki may not meant couple as married or partnered couple, but just two people. If that's the case, I still like my answer. We invest in married or partnered couples all the time. It's actually more usual than not. You'd be surprised. That's really not an issue for us. But if it's just, you know, a solo founder versus 2 versus 1 is much better than 1. And we see a lot of 2-member founders. That's quite all right. And then around those 2 original founders, we'll see a second group, kind of a second valence of what we call key employees. Okay, they're not quote unquote founders, but they're like employee number 3 or employee number 4. And then there's like proto founders and second stage. I mean, so you can have different layers of founders, right? So it's really up to the original founders who they want to grant founder status. It's really more of a, you know, for your own standpoint, professional branding moving forward, you know, that you were a founder, but it doesn't really give you any special rights in the company. I'm trying to see if I have any new questions here. Oh, by the way, Rodrigo, if you saw any that you wanted to pick off, just let me know.
Yeah, I have a quite interesting question here from Santiago. Let me see. It's more technical, but it's quite important to address that question. Do you calculate the terminal value using Monte Carlo analysis or simple calculation? It depends on the information we gather from the companies, but we used to make a lot of sensitivity analysis. In some cases, Monte Carlo analysis would be necessary, but it's not on regular basis. We used to make our calculations as simple as possible to be clear on the negotiation with the founders. So that would be our recommendation. Be as simple as possible.
Yeah, I would just add to Rodrigo's response that, you know, valuation caps and term sheets, that's really a function of market. It gets back to anyways valuation, even though I don't, you know, I'm not in favor of putting a valuation on a startup that just has a PowerPoint presentation. You know, I prefer to do a convertible note with a valuation cap that says, you know, if the company takes off, we want to make sure that we protect ourselves. But those valuation caps are also market driven. A valuation cap in Santiago, Chile is going to look very different than one in the United Kingdom. It's going to look very different than one in Seattle, Portland, or San Francisco. Okay, they tend to be a lot higher here. Like, I'll give you an example. Valuation caps on the West Coast can be around 10 million US. Valuation, and it's an early startup. Valuation cap in United Kingdom, you know, can be 2-3 million pounds, something like that. It's a lot lower, right? And I'm sure it's pretty similar in Santiago. Rodrigo, would you say?
Yeah, but you have a sense. We have a sense because of an inflation in some of the verticals. Fintech would be one of them that we have seen that align with the pricing of or the East Coast or the West Coast, and it's but in other sectors like agtech or edutech, we have seen that we have an arbitration, valuation arbitration between the US or the European markets and LATAM. an opportunity of around between 3.5 and 4.5x between the seed and the early stage of West or East Coast. So there is an opportunity on that, because on the same ground and looking for the same type of companies, valuations are lower here, for sure. 30%.
Totally agree.
Yeah.
Totally agree. So Esteban Schreck, one of my favorite venture capital geniuses and former JP Morgan banker of mine, he's down in Argentina. He has a question: U.S. or international investor? Esteban, if you can unmute, could you clarify the question? You could do both.
So, sorry, Steven, I lost you.
Yeah, Esteban. Yeah, Esteban had a question in the open Q&A, but
okay.
I'm not. Yeah, but he could also answer the question himself because he's very, of course, active in the space. And
I'm trying to find out.
I'm not sure. The U.S. As far as U.S.
Here is it.
Okay.
How do you think about valuation gap given the valuation delta between LATAM rounds and US rounds, thinking that US investors will invest down the road in the company? Yeah, that would be the approach, is to bring, using a corridor between LATAM and the US or Europe, bringing those startups from an accelerator process towards the best of the class from that accelerator stage towards the soft landing in the US. And having this visibility on the US VC industry, you can get that valuation arbitrage from LATAM startups. That would be the scope and the goal, bringing LATAM companies to the US or Europe.
Yeah, I completely agree. I think that's an opportunity, right? I also think it's the opportunity for United Kingdom for US investors. I think if you're trying to get better early stage valuations, you should be looking to Latin America. You should be looking to United Kingdom. Also, I think there's higher quality deal flow down there. We've sifted through all the high quality deal flow on the West Coast. It's so difficult to find like a deep tech, a bioscience, some kind of technology that's differentiates itself then in the marketplace, because it's just so crowded in the US. We're finding really wonderful opportunities, high value opportunities very early in the Oxbridge ecosystem, but also I've been very, very impressed and surprised of what I'm seeing coming out of Latin America. Looks like we have one more.
Yeah, I think that would be the last question, yeah. Steve, given the time, because
okay, we're done.
Capture all the questions in the parking lot. So thank you everyone for being here today. Next Friday at 3 o'clock UK time, we're going to be here again with different subjects, different speakers. So it's going to be quite a session to get valuable information from real venture capitalists, for founders and so forth. So I hope you liked the conversation we had. If you have any comments, please send us an email to cba@cjbs.net to capture all the questions you might have, additional ones. If you would like to have access to the webinar, to the recordings, to the PowerPoint, you are more than welcome. So with that said, we are very thankful for your participation. This was a very attractive session, a lot of engagement, a lot of questions. We really appreciate that. And we hope to see you next Friday at 3 o'clock UK time. Thank you so much.
Thanks a lot, everyone. Bye-bye.